Welcome back. You're watching Markets at Noon. Let's get in our next guest, Pramod Amthe, the Head of Institutional Liquidity Research with InCred Capital. Pramod, I was going through your note. You have raised the NIFTY target by around 7%. So is this increase in the target purely on the back of the fact that you have increased the valuation multiple, or you're even seeing some earnings growth to come in?
So if you look at our basis of raising it is increasing our probability for the bull case scenario as the Fed has rung the bell for interest rate reduction, which also augurs well for broadly the Indian Central Bank to take that action. So we are saying that our bull case argument for the rate reduction along with the global macro factors plus the rural recovery aided by sustained improvement in the rainfall gives a higher probability, and hence we have raised our bull case probability from earlier 25% to 30%. So that is a key reason for raising our targets by around 2-3%. Earlier we were at around 26,500. We have raised it to now to around 26,700. So it's predominantly that valuation-led, macro-led valuation marginal uptick, whereas earnings have held on in spite of the first quarter results and some challenges on the macro front.
And what is the kind of earnings growth that you're expecting over the next, say, 1 year, and which sectors would be contributing to that?
So we are in our calculations, we are looking at a Bloomberg consensus, which is still at the mid-teen CAGR, broadly for the earnings expectation for next 2 years. No change in that. The first quarter, even though we started on a slow growth for Nifty 50 at around 8%, the good part about that has been the sales traction is relatively better. The sales beat for some of the companies have been better than what we expected, while the profit beat was concentrated in few stocks and few sectors. So no major change in our next 2 years view in terms of momentum for the Nifty 50 earnings in the range of around 13 to 14%.
All right. Hi, Pramod. This is Shrishti on the other side. Welcome to ET Now. Firstly, wanted to understand your take that going ahead, which sectors look interesting to you right now? Any of the new ideas that you are looking into, or any of the new additions that you have made in your portfolio?
So what we are looking at is definitely upgrades coming through in the FMCG space and the rural-led ones, which continues to give us a comfort. So if you have to look at some of the numbers which we have been able to upgrade along with the stock ratings are clearly, as you mentioned, are on the FMCG's back, Marico and Britannia, and the Hero MotoCorp, which all add up into that space. IT we are constructively looking at, but I think the key theme will remain how the commentary for the second quarter results is going to be. But incrementally, we are looking at more traction to come through in IT. So that's where LTI entry is the one more to add on. So those are the sub-segments where we are clearly looking at the rating upgrades and more conviction from the analysts to on the numbers upgrades to continue based on the macro tailwind on rural.
Pramod, I also wanted to touch more on the auto space as well, because the sector overall on a YTD basis has already run up 40%. But you still continue to be bullish in Hero MotoCorp, like you highlighted as one of your recommendations or top bets right now. Tell us more that what exactly looks interesting in the auto space to you, as well as any pecking order theory in this particular space, like Hero MotoCorp is one, and then followed by the rest of the counters, if you wish to highlight.
So if you look at our broader sector rating, we turned cautious somewhere in May for the broader auto sector. We are neutral on the sector rating versus the broader index. Within that, we are more selective on stock names, as seen in the broader volume growth is also turning more and more selective on sub-segments and the individual companies within that sub-segment. So we are clearly more comfortable in the two-wheeler where the double-digit volume growth is there. Plus, we expect the festival momentum to accelerate this double-digit along with the government policies ahead of the state election. So that comfort is there on two-wheelers. Whereas within two-wheelers, the entry levels is where the comfort is better as compared to premium. Broadly within autos also, if you look at premium segments, have disappointed in the last couple of months. versus the entry level, which is coming back after nearly 2 years of lull. So our preference in autos is definitely Hero MotoCorp in the short term, where the product action along with the which should support their market share recovery, uh, plus the really comfort on the valuation, which aids them. That's the preference. Second, followed by Maruti, where we feel that relative to the industry inventory, they are better off, and the focus is more on CNG and Ertiga-led ASP-driven profitability. Those are the more preference within CV space, where the recovery on the medium term is sustainable. We are more selective on Ashok, where the pricing power and margin recovery upgrades are coming through. So these are the only three names which we are positive on OEMs. The rest all we have hold or sell.
Okay. Pramod, when it comes to the cement sector, you continue to remain overweight on this sector. Aren't you worried about the weak pricing environment that we have been continuously seeing in this space, or do you think that the 9 to 10% volume growth and margin efficiencies would make up for the lower prices or weak pricing?
So I think the recent channel checks also indicate that the pricing environment is relatively benign. That's where I would say there has been a marginal disappointment. Either if you look at broader economic activity post-election pickup has been more gradual, which is also reflected in the infra and the cement prices. We are hopeful that the second half should be a better one. And as the more state governments come with the elected power. So we are of the structural thinking that cement should come back into limelight. So this is more like a short term. The short term theme which has played out is more about consolidation, which has led to the tide rising on the valuation front. But however, the recovery is more back-ended for second half and next year. So hence we are more constructive on larger names within cement as compared to smaller names.
Pramod, share your take on the PSUs as well as defense in the railways basket specifically. Why so? Because these sectors are seen to be taking a breather in the recent while, and especially the retail investors were a little concerned about the stock movement. But as we keep talking to the experts, they continue to be bullish in the long run. So share your take on the sector as a whole. Do you believe that the recent correction is a good time to enter back in any of these stocks, or this sector is overly valued and one should like stay away for some time now?
So the risk reward is still not favorable. Clearly, before the elections, we have taken out defense from our high conviction list or the overweight scenario. We continue to hold the same, especially where the in the new coalition movement, we need to get the policies action in place considering the rich valuation. So those two sectors are still, we are more cautious. I would say the better proxy to play through is the capex-led capital goods, where I think even the first quarter GDP indicates some amount of comfort on private capex coming back. That's a relative overweight for us versus the sub-segments of defense and the PSUs.
All right, Pramod, with this, we'll let you go on that. Thank you so much for joining us today and sharing your take on the markets as well as telling us which ideas are still looking interesting to you.